Good morning, everyone. Thank you very much for joining us today. My name is Cully Samra, and I'm Head of Customer Engagement here at AJ Bell. And I'm delighted you've made the time to join us today to talk of pensions. We get a lot of feedback from our customers. It's a very engaged bunch, and we hear a lot of questions around pensions and really getting to the nitty-gritty of some of the things that surround pensions that impact how much we can actually contribute into our pensions. So based on the feedback we've received, as you would have seen in the invite, we've set up a series of 3 events over the next few weeks, which cover some of the main topics that have come up. First one today is going to be about tapering. If you're a high earner, the tapered annual allowance really reduces how much you can pay into your pot. And in order to discuss how the taper works and what happens if you exceed it, we have one of our experts, Charlene Young. Charlene is our pensions and savings expert. She joined us from a wealth management firm where she worked with private clients. So she has some real first world experience in discussing with customers how these type of topics really impact customers and their pensions. She holds a chartered financial planner status, which I know firsthand is not very easy to attain. So she also has the academic knowledge as well as the real world knowledge as well. And she's also associate member of Society for Trust and Estate Practitioners. I hope you'll excuse me, I had to read that off because it's quite a mouthful, but that also is a very important industry body that Charlene contributes towards. Just a bit of housekeeping. Charlene's presentation is going to be around about 20 to 25 minutes. Then we're going to open up for questions. There are some questions that were posed to us before the event. We actually asked for people to ask questions as they were registering. In order to actually pose anything you want to ask Charlene, you'll see in the sort of dialogue box, there's a box called questions. And if you click on that, you should be able to type in a question, which I will keep until towards the end, and then we'll pose them to Charlene. If you have any technical issues, there's also a chat box as well. You can type those in there. My colleague Lisa is monitoring if there's any technical issues, and we'll try and make sure we can help you. But I hope you enjoy the next 25 minutes or so. And as we said, please do ask questions. We'd love to engage with you in any way that we can. Thank you. Over to you, Charlene.
Well, thank you, Cully. That's a lovely introduction. And hi, everyone, and welcome. And thank you so much for joining us for today's webinar. So as Cully mentioned, this is the kind of first episode, if you like, in our pension series that we put together. And we're going to jump straight in and look at the tapered annual allowance. So nothing like starting with one of the trickiest topics in pensions. So yeah, like I say, thank you for joining us. As with all these things, I do need to just kick off with a couple of points myself. Firstly, that we don't offer financial advice at AJ Bell, so we won't be able to recommend a course of action for anybody. If the information today makes you feel like you need some help, then we would strongly suggest finding a financial advisor or an accountant to help with the tax areas. Pensions do come with their own rules, as we all know, and they can change over time, including the tax reliefs that apply. And although we've got some time for questions at the end, like Kelly mentioned, we definitely welcome them. I won't be able to sort of calculate annual allowances for anyone or make any personal recommendations, but hopefully be able to provide you with some really useful information. So just to go over what I want to cover with my kind of just over 20 minutes with you, maybe 25 if I go off on a bit of a waffle. And I'm going to start with a quick introduction about saving into pensions and some of the kind of the basic concepts to get us started. Then we're going to explore the detail of the tapered annual allowance a bit further. So looking at how it operates, what it actually is, and then those income limits, the all-important income limits, and some calculations with a couple of case studies there to kind of bring the figures to life. Then I'm going to finish with how and when you might be able to carry forward unused annual allowances from previous years and how that interacts with the tapered annual allowance. And finally, what you need to do if there is a tax charge to pay. So if anything I cover sparks your interest further and you'd like a bit of reading material, if you're like me, sometimes you like to go away and think about things, we have a series of free guides available at our website as well. So just head to www.youinvest.co.uk after the session if you'd like to download those. So kicking off with our presentation today. So the government gives tax reliefs and incentives to people and businesses on the money that's paid into pensions. So that's just to encourage people to save for their own retirement. and not to have to fall back kind of just on the state pension and state safety net. And as we know with pensions, once the money has already been saved into it, any income or profits generated on those investments inside a pension are free of tax as well. So a question we get asked a lot, and I'm sure has been on your mind from year to year, is how much can I actually save into a pension? And of course, our view at AJ Bell is that it should be easy for investors to be able to work out what they can save for a year, but the reality is sadly a little bit more complicated. So I've already mentioned the words tax relief, and that clearly is one of the kind of big carrots, if you like, that the government likes to dangle in terms of trying to get people to put that extra bit away for their retirement. Contributions, so money paid into a pension, benefit from tax relief, and they can be made by you personally, as well as by your employer if you have one. Personal contributions, so those we make ourselves to a SIP, will be topped up by the government with tax relief at the basic rate of 20%. So just to kind of recap on that, on tax relief, for example, if you paid in £800 to your SIP, the government would add another £200 in tax relief, meaning that there's £1,000 gross, we call it, inside the SIP there. If you pay tax at a higher rate than basic rate, so you're 40 or 45% tax, then you can claim further tax relief by contacting HMRC. This extra relief will be paid to you directly, or it will come off your tax bill when it comes to submit your self-assessment tax return, and it will be dealt with on that calculation. Okay, so a very quick part on tax relief there. So as the tax relief can be generous, especially if you pay tax at those higher rates, there are, of course, limits that apply. And the first limit is in relation to tax relief, and that is that you can pay in up to 100% of your UK earnings and get tax relief each year. So that's UK earned income. But kind of moving on to our main focus today, there is something else to consider. It's not just all about tax relief, and that is the pension's annual allowance. Now, often I see the annual allowance written about as a limit on the amount of tax relief you can get, and being probably my background as a technician, that's not strictly true. Whilst both things apply, both concepts apply to pensions, tax relief and annual allowance are actually sort of separate things that we need to consider. So nice and simple there. So the annual allowance, it covers and looks at something known as pension input. Now, I don't like to include jargon, but I will let that one particular point slide, because all this means in terms of pension input, that's the value of the money that's being paid in by or for you across all of your pension schemes for a tax year. So what you pay in yourself, any basic tax relief top up from the government, and anything paid in by an employer too. So for things like SIPs, it's easier to calculate because it's that gross figure that's been paid in by or for you. With defined benefit schemes, the pension input is calculated using a particular calculation. Those of you who are members of those schemes might be familiar with that. I think the really important thing to be aware of is that the annual allowance isn't like a hard limit. It's not a ceiling, and then all contributions above that are kind of banned or returned. But what happens is any funds that are paid in above whatever your annual allowance is for the year, they will likely attract a tax charge. So you still get tax relief on one hand on those contributions you're paying in yourself, or your employer gets their own tax relief on money they pay in for you. But on the other hand, you might have this tax charge that comes in on that excess amount above whatever your annual allowance is. Okay, so that excess pension input. So what is this annual allowance? Well, the standard annual allowance is £40,000 for the tax year. But as we know, this gets tapered down for people with high incomes, and that's what we're going to concentrate on today. Okay, so on to the kind of main event, if you like, of today's presentation, the tapered annual allowance. Now, this was introduced in April 2016, and it meant that pension savers from that date now effectively had 2, if not 3 different types of annual allowance to navigate, as well as thinking about tax relief. So things really did to start to get even more complicated at this point. So for the taper to apply, there are 2 income limits that need to be breached. And the taper works to reduce your standard annual allowance from that £40,000 for somebody in a particular tax year. So it could be that one year you're subject to the taper and the next you aren't. So it's really a kind of assessment that happens every tax year. As we mentioned before, you can still get tax relief, even if you pay in contributions over and above whatever your tapered annual allowance ends up being. But then, like the standard rules, a tax charge will apply to this excess. Again, like the standard rules, this tax charge is a personal tax charge faced by us as individuals. You could end up being faced with it even if you don't actually pay that much into pensions, or it doesn't look like you pay as much in as the tax charge would indicate. And that's because it looks at total pension input, so everything paid in by your employer as well, if you have one. So if you have large employer payments, whether regular or one-off, these will count towards the possible tax charge that you pay. So this is how some people in public sector schemes in particular might end up being caught, where perhaps they weren't expecting to. Often see this as one-offs if people were promoted or take on additional work in the year that increases their pensionable earnings and their input. The increased payment to them kind of tips them into these rules, whether it's for one tax year or on an ongoing basis. So this slide that I'm going to bring up now is just a real at a glance to kind of see whether or not the taper might apply to you in a particular year. It's not particularly scientific, but we find that customers kind of enjoy it as a very high level reference guide. So at a glance, if your income, so we're talking about not just earnings here, and we'll talk about income in a second, but this is income for a year, is under £200,000, then you probably don't need to worry about the taper. As I say, remember here we're talking about income, not just earnings. So things like dividend income and property rental income come into play here when you were thinking about annual allowances. If your income is between 200,000 and 240,000, then you might have to do some calculations to see if this taper is going to catch you. And if your income is over 240,000, then it is very likely you will be subject to the taper. And again, a calculation will need to be done to see by how much and what your kind of personal tapered annual allowance is for the year. So hopefully that's kind of useful as a reference guide. Now, how do you actually work out your tapered annual allowance if you think you are subject to it? Now, as I mentioned, there are 2 income limits that need to be breached, and they are known as threshold income and adjusted income. So these are the current limits, if you like, for both of those. So adjusted income is £240,000, threshold income is £200,000. And they have been the limits since April 2020 onwards. A quick word, and something we'll come on to later in the presentation on this, is before this, so when the taper was introduced in 2016, the income limits were quite a lot lower. So they were 150 and 110 respectively. But the minimum allowance, so the kind of the largest effect of the taper, if you like, the minimum allowance was down to £10,000, whereas now we can see that if you have a high income, your minimum allowance could be as low as £4,000. So in previous years, more people were potentially caught because those income limits were lower, but they might have not had quite such a low tapered allowance as we face now. So if both of these income limits are breached, the annual allowance, so that standard £40,000 that we start with, starts to get reduced or tapered down, and it's reduced by £1 for every £2 of income above that adjusted income limit. Okay, so by my calculations, I think it's £312,000 now, income above £312,000, and you will be subject to that kind of minimum allowance of £4,000. As I said, it's worth bearing in mind that the limits used to be different, because this might come into play later. Okay, so moving on to the kind of detail of these income thresholds, because things can get a bit tricky here, and this is an area where we definitely recommend perhaps speaking to an accountant or registered tax specialist if you're not sure, and especially if you're someone whose earnings can vary from year to year, you have fluctuating income, or you have multiple income sources, because it can be a little bit on the confusing side. So as I mentioned, the two income limits are known as threshold and adjusted income. Just excuse me there for a second. So our starting point with both measures is this concept of total net income. Now, sadly, net here doesn't mean anything like after tax, and this is often the kind of first layer of confusion, if you like. This is the term we're given, total net income. It actually means all taxable income, and we think of it as before any pension deductions. So it really is everything that kind of goes into that tax computation. So simple things if you like salary and bonuses, but also any pension income you already receive, including state pension, trading profits from your business, income from property, so rental income, personal rental income, dividend income, and interest from savings accounts. So really everything that goes into that kind of tax computation pot. It also includes any taxable element of any kind of redundancy or severance packages there. So once we know that total net income, that's the starting point for both measures. We're going to look over on the left at threshold income first, the first of our measure. So here we're looking to see if this £200,000 limit has been breached. And if it is not exceeded, you don't need to then move over to the right and look at adjusted, because as we know, both these limits must be breached for the taper to apply. So it's a good starting point to start with threshold, really. So we take this total net income, and then we add something back in. And what we add back in is any kind of new salary exchange agreement that's been made. So salary exchange or salary sacrifice, if you know it by that name. And it's any new agreements entered into since the 9th of July 2015. Now that might seem very random, but that's actually to capture the date that the new rules were announced, but they hadn't obviously quite come into force until April 16. So a kind of anti-avoidance measure, if you like. So this is talking about new agreements, and that could include variations to existing ones that were already in place. The kind of ones that won't be caught are agreements you were already in and they haven't changed, or they might have accounted for certain sort of prescribed increases. So as long as no terms have been varied, you haven't kind of signed up to anything new, that might not be caught. But again, probably one to get a little bit of legal advice on, just to be sure. So then you have two possible deductions. So the first one is personal contributions. So this is just the amount of money you have paid into a pension, whether or not it was after tax, so into a SIP, for instance, under what's known as relief at source, or it might be that you see it on your payslip as a pension deduction before tax. Okay, so whatever method of tax relief, you'll know probably which one applies to you. If it's money that sort of come from you personally, you can take the gross value of that. The second possible deduction is a little bit niche, and it's quite rare. It might not apply to you, but it's if you have received any lump sums in that tax year from another person's pension when they died. So you will know if this applies to you, and you can take that off. And it's ones that are subject to tax that would come in ordinarily into this total net income. Okay, so if you haven't reached the threshold limit of £200,000, then the taper doesn't apply to you. But if you have, you then need to look at your adjusted, because that helps us work out the taper. So we go back to the same starting point of our total net income, and we add something back in, and you add back in the value of any employer pension contributions made. Now, if we're talking about things like personal pensions, group pension, workplace pensions, where it's pounds and pence value, it's easier to identify. If you're a member of a defined benefit scheme, you will have a calculation that needs to be done by your scheme to show you what the total total pension input is, I should say, and then you can take out whatever you paid in that calculation. So a little bit more complicated for those of you are members of defined benefit scheme, but you should be able to get this information from your pension scheme provider. Again, we've got that deduction there of pension, lump sum pension death benefits subject to tax. Again, probably won't apply to most of us, or certainly if it ever did, it probably only in 1 year. So those are our two measures. You see that adjusted sort of inflates, it adds back in those employer pension contributions. And then once you've got those two figures, if they're both breached, you look at the adjusted income, how much it exceeds that 240,000 to work out your taper. Okay, so if you're like me, sometimes it's easier to kind of put these figures into practice with some case studies. So let's have a look at Jeremy. So he has employment earnings of 200,000, a car allowance of 7, and then total pension input, so this is to a group personal pension, of £40,000. 15 of this was made by him, gross, and 25,000 by his employer. So first up, let's look at threshold income, and we can see here that the limit has not been breached. Jeremy's threshold income is that 200,000 plus his 7,000 car allowance, but because you can take off that gross personal pension contribution of 15, he comes in under the threshold. We don't need to look at adjusted income. The taper does not apply. So now we're going to look at Kate. Slightly different scenario, and I think you probably know what's going to come here. So her total salary is 220, property rental income of £20,000, and all pension contributions valued, all that input is £30,000. So 10 of that gross is personal and 20 employer. So threshold income here, the limit is breached. Kate's income there, so you take her salary, you add in the property rental income, and take out that £10,000 gross personal contribution. So now we do need to look at adjusted, and we can see here that this is also breached. To work out adjusted, you take the salary, we take the property rental income, and we add back in that employer contribution. So there we can see that Kate's adjusted income is £20,000 over the £240,000 limit. So on our 2-for-1 basis, her annual allowance is reduced, and it's reduced down to £30,000. Kind of handy for this example that that's exactly what was paid into her pensions for and by her employer, but that is Kate's taper. So what if Kate's income meant that her tapered allowance was actually lower? So she'd actually paid in more than her tapered down annual allowance. Does that automatically mean she faces a tax charge? Well, thanks to carry forward, maybe not, because even if you're subject to the tapered annual allowance, you are still able to carry forward any unused allowance from up to 3 previous tax years. So this might work to reduce or even eliminate those excess contributions and any tax charge altogether. So kind of just 3 things to know about carry forward here. You can always go back over the recording if you want to listen to them in a bit more detail. So depending on what your annual allowance has been in the past 3 years and what you obviously paid in for those years, you might have unused annual allowance. And when we're talking about the tapered annual allowance, there is another layer to think about, and that second layer is, you need to figure out whether you were subject to the taper in any of those years as well. So work out for the previous 3 years what your tapered annual allowance is, if you were tapered. If not, it might be the standard. And then you look at your pension input for those 3 years. So if you do all of those calculations and you've got some unused annual allowance, then you can use that against any excess you've got in the current year. As I mentioned near the beginning of this, do bear in mind that the income limits and the minimum tapered allowance were different for the year 2019-20 and any earlier tax years. So that's still relevant if you're looking at this tax year and going back 3 years, or even if you're doing your tax return now for last year and you're going back 3 years before that. So really kind of important to bear that in mind. So you'll need to do that calculation for each of those years, or have an accountant or tax specialist do it for you, or even just check it over. We really suggest that because it could be definitely worth it, especially if it leads to sort of a tax saving or even eliminates that tax charge. Okay, so that was just a quick word on carry forward. Some people will still need to pay an annual allowance tax charge, even if they've got some carry forward there. So just to kind of go through the basics of the tax charge itself, this will apply to the excess that's been paid in across all of your pensions for or by you above whatever your annual allowance is. So whether it's the standard and you've still got higher pension input, or whether you are tapered and you've got that higher pension input as well. And as I mentioned, it's a tax paid personally, even if the tax charge sort of results from employer payments. So sometimes that's a bit of a shock to people if it's a kind of a new thing to them for this tax year. So as I mentioned before, you do still get the tax relief, or your employer gets their employer tax relief on what's paid in, and you should absolutely still claim it, and you can do that via your self-assessment, but the tax charge will then work to kind of reduce the benefit of it on the excess payment. So this is where I get my kind of stickler hat on, and it doesn't necessarily limit the tax relief, but it obviously works to limit the benefit of it on that excess amount above whatever your allowance is. Now, it does definitely depend on your own personal circumstances, but some people think of it as saying, right, well, I will still go ahead. I know I'm probably going to have a tax charge because I've got money inside my pension or my SIP at the end of the day, but again, it's a very personal decision. For some people in certain schemes, that might not be the case. So it really is something to kind of appraise on your own circumstances there. So in terms of working out what the tax charge might be, so we look at what that excess amount is. So your total pension input less whatever your annual allowance and then carry forward is, and that chargeable amount is then added to your taxable income for the year to work out the rate of tax. So it's not a flat rate percentage charge. Perhaps that would be easier. It certainly would be easier to understand, although it might be more punitive to certain people, I suppose. So it's paid at your marginal rate. So you might find that you pay a bit of the tax charge at 40% and a little bit at 45%, or all at 40%, or some at 20%. It really does depend on the kind of shape of your other income for the year. So this is where sort of a tax specialist can come in. Now, one thing to really be aware of is that although you have to, the charge is a personal tax charge and you have to report it on your tax return at self-assessment, you don't necessarily have to pay it from your own pocket like we might do other tax charges. So you can ask your pension scheme, one or some of your pension schemes, to pay it directly. In some cases, if you ask them, they must do it. There are some sort of rules that need to be met for that. But in other cases, they may agree to do it on what's known as a voluntary basis. So if you think this is going to apply to you, ask your pension scheme about the scheme pays rules. At AJ Bell, we can pay all or part of the annual allowance tax charge. We need to get some information from you to help with that. But we can do that on the voluntary basis, which means we can do that even if the tax charge results from contributions to another scheme. So for instance, if you're in a defined benefit scheme, but you want to use your SIP to pay that tax charge, that's absolutely possible. And do get in contact if you think that might apply for you. We also have a guide on it available on our website. So that brings my kind of content bit of the presentation to a close. So thank you for bearing with me today. I've slightly gone over time, keeping to my form, and just thank you so much. Not everyone is into pensions as much as I am, so I'm just really thrilled that so many of you could join us. Don't forget, if you need some more information, we have those guides available at our website, www.youinvest.co.uk. There's one on scheme pays, there's one on carry forward. So fill your boots if you really want to do some extra reading about it. If you've got any queries specific to your AJ Bell account, our customer service team always happy to help as well. So I think Kelly's got some questions ready for me. So I'm going to hand back over to him, and he is going to pose those to me now. So yes, I won't be bated breath.
So Charlene, thank you very much for that. Your passion for pensions certainly comes through. And just to reiterate what Charlene said, we have some very extensive content on our website. And if you go to the Youinvest site, there is a pensions and retirement section where you can actually look up a lot of the different guides that Charlene referred to, and also the recording for this event will be on that website as well. So just a reminder, if you have more questions, we received some already, and I'll go through those in a second, but we just need to go to the questions tab, type in your question, and then just press return, and that'll come through to us, And of course, there's the chat tab as well, if you have questions there. So Charlene, we have a few questions. Hopefully these aren't too sticky and complex to cover. You'll know better than I do. The first one relates to making a gift. And the question reads, making a gift to a registered charity gets tax relief. Could it help reduce my income for the tapered annual allowance calculations?
Oh, right, yes, thank you for this one. So yeah, that's correct. If those of you who make gifts might be familiar with the concept of gift aid, now the charity can get tax relief on that, and you can include it on your tax return, but sadly it does not work to reduce the income for these limits. There are some very specific gifts that do so. If you gifted shares directly, I believe that might work, but if it's a cash charity gift that some of us do make, although it might reduce your tax bill, so it might reduce the eventual tax charge you pay, it doesn't reduce your income for the taper calculations, I'm afraid.
Great, thank you. And just so everyone knows, we're going to spend about 10 minutes or so covering some of the questions that we've had come through. The next question I have is, can AJ Bell pay a voluntary annual allowance tax charge for a workplace pension that is a DC, not a DB scheme? Is there a minimum amount and any deadlines for these?
Oh, well, there's quite a lot to cover in that question, but the kind of basic answer is yes. So we do accept applications for what's known as the voluntary scheme pays charge. So if your other scheme was another DC one, then that's fine. If you've got to sit with us, we can look at that tax charge. So that is absolutely possible. There, we would need kind of information on the total pension input to the other scheme, and a few more details from yourselves. There are, we don't have our own deadline, if you like, but there are certain deadlines that you need to be aware of. The guide goes into quite a lot of detail on this, but at a very high level, the kind of usual self-assessment deadlines apply to pay tax charges. So if you do think you want to use it or it's going to apply to you, the quicker you can get in contact with us, the better, because there's sometimes a period of time between when we can deduct it and then when we do our own pension scheme tax returns on a quarterly basis. So definitely want to have a look at the guide. If you've got any more questions, do get in contact with customer services and we can certainly look at that one for you. Thanks for that question, that's a good one.
Great, thank you. The questions are coming thick and fast. So next question. If you are wanting to utilize unused allowances from the last 3 years, is there a particular process you need to go through?
Yes and no. So to use the carry forward allowances, you must have breached whatever your own annual allowances for the tax year. So whether it's the standard or the tapered. And then in terms of process, it probably just applies to you. So you do need to go and get information, if you don't have it already, on those 3 previous tax years. So the total pension input, do that calculation to check whether the taper applied in any of those years. I suppose in terms of pension rules, there is a little bit of a funny process you go through that we're in this tax year now, and then you go back to the oldest of those tax years to look at first. And that just means that you're kind of mopping up anything that would fall out when we move into a new tax year. So you do need to have been a member of a pension scheme in any of those years you're looking to carry forward from. For most of us, that's not going to be an issue because now, especially with auto enrollment as well. But it's definitely, yeah, those are the kind of the main things that spring to mind. But it's all about information again and calculations, I'm afraid.
Great. Charlene, I'll be impressed if you can answer this one because you'll have a crystal ball. Has the government given any indication that the limits will be increased in future years?
Well, those of us who work in pensions, every year there's sort of like a little bit of a media storm, and believe it or not, we don't try and create this, that limits are going to be changed. Now they did increase them, obviously back came in from 2020, didn't it? And there is sort of significant weight behind an argument, specifically for people who are members of the NHS scheme. And it's not just that scheme, but that's the kind of best and most widespread example. Where people are sort of getting caught by this for taking on additional work. So the government, I suppose, at the moment as well, I don't think so. I don't think these limits will be increased. We would like the system to be a lot more simple. It's horrendously complicated for people to navigate, even if you have a high degree of knowledge on pensions and you work in this industry. So I think that's the kind of worrying. We would like to just see this regime of 3 possible annual allowances go, but sadly I can't really give an answer to that one.
Okay, I don't blame you. As I said, you might have had a crystal ball to answer that question. So as I say, a lot of questions coming through. One asks, I've received a payment as part of a redundancy package. Does this count, and could it push me into the taper, even though it's really a one-off spike this year?
Yes, so redundancy packages. So generally, the first £30,000, I believe, of a redundancy package is tax-free. And then anything above that will be added to your income for tax for the year. So even though it's generally going to be like a one-off spike, like you say, it's not necessarily going to happen each year. Whatever the taxable part of your package is, if it is worth over £30,000, that taxable part will count towards that kind of total net income at the first stage of both of our income threshold income limit calculations. So yeah, anything above 30,000 is what to watch out for, that taxable bit.
Great, thank you. So we'll spend another 3 or 4 minutes going through these questions. Unfortunately, we can't answer all of them, but thank you for your engagement. Next question is, if you breach your annual allowance, am I right in thinking the onus is on the individual to report this excess to HMRC via self-assessment? Do pension schemes report each year to HMRC about how much you have paid in from all sources?
Right. So yes, in terms of like working out what your tax charge is, the onus is on you to do that via self-assessment, because that will be sort of personal to you. In terms of the information we have to give HMRC, so we make returns, so our own tax returns, because we reclaim that, that basic rate top up on your behalf. So that's one return that we have to do. And then we also have to let you know, as the pension investor, whether you've made contributions to our scheme above the standard annual allowance. So the tricky bit here is that that it only applies to us where we're talking about that standard £40,000 allowance. Of course, if you ask us, we can provide the information to you as well. But somebody subject to the taper will have an annual allowance of less than £40,000. So if they've contributed, say, £20,000 in total, they wouldn't necessarily automatically get a statement from us, but they might breach their own allowance. So it's where the kind of the rules and real life kind of collide, and not in the most helpful of ways. So the one thing I would say is sort of don't count on them never catching up with you, because they obviously can go back a number of years to investigate tax returns, and obviously mistakes do happen. I'm not suggesting anything disingenuous, but yes, the onus is on the individual. The penalty is potentially on the individual, so that's why kind of information is power on this topic, really.
Okay, great. I'm going to make this the last question, Charlene, and thank you for all your answers. Does foreign income count towards the limits?
What was that? Sorry, was it foreign income, did you say?
Foreign income, yeah. Does foreign income count towards limits?
Right. So generally, when we're looking at our threshold and adjusted income limits, it's UK taxable income. Right. So anything that's taxed in the UK. Now, some people might be taxed in the UK on some of their foreign income, and if that's the case, it probably will be caught. But if it's taxed overseas under a double taxation treaty, so I'm trying to think of the word there, then it's likely it won't be included. So really, you're zoning in on what you pay UK income tax on for those limits. So hopefully that's answered that question. Thank you.
Yeah, great. Excellent. Charlene, thank you very much for your answers and the presentation. Ladies and gentlemen, thank you all very much for your engagement. Really appreciate some of the questions, and I hope that you came away knowing a lot more about tapering than when you joined us.